While the retail crowd is busy fighting over the crumbs of overextended AI giants, a massive macro shift is quietly taking place. This is happening in the shadows of the small cap market, with a widening disconnect between big money and average investors. Today, we expose two silent AI engines, companies providing essential infrastructure for the next wave of automation. One is trading at a staggering 0.69, the other positioned at 221. Here's the catch. One manages the human-to-AI operational bridge for global enterprises. The other acts as the cloud nervous system for billions of smart devices. Which one is being accumulated by institutions while its price remains stagnant? Let's find out. As AI infrastructure expands from massive data centers into defense, healthcare, and automation, the SaaS layer is no longer enough. The market is inefficient. Everyone looks at the brain of AI, but no one at the nervous system. Institutions quietly watch this layer because pricing inefficiencies exist where business models are complex and tickers are small. Small caps are volatile, but this explains why this area matters. While headlines focus on mega caps, this is where smaller cap opportunities tend to form. Our first company is the operational engine. It solves the biggest problem in tech, the gap between owning AI and making it work. They specialize in technology services that allow massive organizations to integrate AI into their DNA. Without this integration layer, AI is just an expensive toy. Before we reveal this 69-cent play, Stockner2 operates on a different scale, connecting physical hardware to the cloud. Businesses are desperate for digital transformation. If this layer expands, companies move from experimenting to deploying AI. This specific management and technology service layer becomes the bottleneck. They are the implementation backbone. Looking at the price action, it moved from highs near 2.0 down to current levels under $0.70. It has spent weeks stabilizing, forming what looks like a consolidation base. Is the market finally recognizing the value in this digital-first service provider? Their business model relies on high-value partnerships and long-term deployment. They work as an outsourced tech hub for global brands, ensuring AI investment produces ROI. When you look at the company behind this operational niche, the valuation gap is hard to ignore. The company is Ares Technology Inc., ticker AERT, currently trading at just $0.69. Why is it still cheap? The market views it as a consultancy rather than an AI enabler. This is a classic market gap. This doesn't mean it moves tomorrow, and there are real risks regarding liquidity and growth scaling. Timing is key, but institutional interest in digital transformation suggests this story is far from over. Now, before we get into the second stock, here's something most people completely overlook. Even with exploding AI demand, some infrastructure players see delayed price reactions. Their primary revenue comes from cloud and IoT sectors, now reclassified as AI plays. Unlike the first company, which focuses on the human and operational side, our second stock is a pure hardware-to-cloud play. Where the first operates in services, this one operates in the sensory layer. It is the challenger to the status quo of how devices interact with artificial intelligence. This company provides a global IoT cloud platform. Imagine millions of smart home devices, industrial sensors, and lighting systems, all needing to talk to one central AI brain. This platform is the bridge that makes that conversation possible. If AI adoption continues and we move toward a world of autonomous everything, demand for a standardized cloud platform will skyrocket. This type of company naturally becomes more relevant as connected devices grow into billions. This stock has seen significant volatility, moving from previous highs above $4 down to the $2 support zone. It is currently hovering around 221, appearing to wait for the next major catalyst in the IoT sector. This is where it gets interesting. When you look at the sheer volume of devices already using this platform, you realize this isn't a startup. It's a giant in hiding. The company is Tuya Inc., ticker Tuya, trading at $2.21. It remains cheap due to broader market concerns about international tech and cloud spending. This doesn't guarantee anything, and there are real risks involving geopolitical tensions and competitive cloud pricing. Now, we have a mental battle. On one hand, AERT 0.69, the operational backbone that helps businesses integrate AI. On the other, Tuya 2.21, the cloud backbone that helps devices scale. One offers higher asymmetry due to its sub-dollar price, while the other offers a more established global footprint. Which one benefits faster if AI scales? Services that implement tech or the platform that connects it? This tension is exactly what investors are weighing right now. Both AERT and Tuya represent the silent engines of the AI infrastructure layer. This layer moves later than hype stocks, but often more aggressively once the market realizes their necessity. We are looking at a clear market inefficiency where the backbone is priced lower than the face of AI. If you want to stay ahead of these institutional shifts, make sure you're tracking these infrastructure layers. Let us know in the comments. Are you betting on the services or the platform? We'll see you in the next one. And here's another angle almost nobody is discussing yet. As AI becomes more embedded into everyday business operations, the companies controlling the middle layer of infrastructure could become increasingly important. Not the flashy consumer apps, not the trillion-dollar headlines, but the systems quietly handling deployment, communication, cloud coordination, and operational execution behind the scenes. Because eventually, every major AI system needs three things: implementation, connectivity, and scalability. And this is where both of these companies sit in very different ways. AERT operates closer to the human integration layer, helping enterprises actually adapt and manage technological transformation internally. Meanwhile, Tuya sits closer to the machine layer, the ecosystem connecting devices, sensors, and cloud communication across smart environments. But here's the catch. Most investors still evaluate these companies using old categories: consulting, IoT, cloud services, instead of recognizing how these sectors are slowly converging into the broader AI infrastructure economy. And historically, some of the biggest pricing inefficiencies appear right before the market changes how it classifies a company. That doesn't guarantee either stock suddenly explodes higher, but it does explain why smaller cap infrastructure stories can sometimes move aggressively once institutional attention rotates into overlooked areas of the AI market.